It is a very common generic question that may comes into your mind that how when the Federal Reserve, sets an interest rate in an economy, how it flows to the real economy and how it affects the businesses and people in general. What are the mechanics? Maybe you are too much interested in this, so let's figure this out. Whenever there's a change in the interest rate in an economy, it's about the Fed's funds rate. Okay. It's there's a central bank funds market and the banks in that economy trade between themselves and trade with the central bank in that market. Okay. So now what happens here? There are a lot of banks involved in this system. When they just feel short of the reserves, these banks feel the need to trade with the central bank in the central bank funds market because the Federal Reserve is the lender of the last resort. There are two parts of the balance sheet of the bank. One part on the asset side, banks have loans, and against those loans on the liability side, the banks have deposits to pay on demand. Okay, so when there's demand of deposits, let's suppose a bank does not have reserves in its lockers to honor those demand of deposits. So what the bank is going to do is that bank is just first try to get into the interbank market. That's another market where the trading happens between the banks. But if the bank does not get the money that it needs from the interbank market, it can go towards the lender of the last resort, which is a central bank. And in that market, it gets the money at the interest rate that the Federal Reserve actually issued in the economy. So, whenever there's the interest rate is higher in the economy, the bank will just get involved less in the lending to just keep itself safe zone so that there's no need to go to the lender of last resort if it does not have reserves against those deposits. So let's make two scenarios here. To make the concept more clear, let's suppose there's a contracted economy. And what is the situation in that economy is right now is that the inflation is just too much low. Okay, it's close to deflation because the central bank has its mandate to keep the inflation at 2%, around 2%. So inflation is necessary for it. Why it is so low? Because of the less economic activity. Okay, because the businesses are not taking on more tech. It's just a general assumption in the developed economies, and it actually happens in the developed economies because in the developed economies most of the businesses are started and expanded by that generally. So what happens here in this kind of situation? Federal Reserve lowers the interest rate. Let's suppose before lowering the rate was 3%. Now the rate is around 2%. It does not generally happen suddenly, and this rate is just slows down on a gradual basis. So, what happens here is that one of the bank in the economy, let's suppose it's only one bank right now, in between all of the banks, one of the bank can take more risk to issue more loans. How? Because in that time of emergency, it can just simply tap the federal funds facility at a lower rate now. Before that, the bank was issuing mortgages at let's was 4%. Now it can issue mortgages at 3% because in the time of emergency, it can just simply go towards the federal funds market and get the money at just 2% rate. So this is how one bank gets competitive against other banks, and at the same time other banks also do the same to get the competition to grab the customers. So there's lower interest rates actually flowed into the economy now, and people will have now more access to financing to get businesses run and to expand their businesses, and that's how the economic activity actually booms in the economy. So now let's suppose the economy is too much booming. There was too much economic activity right now. The inflation will soar up because in the high economic activity, people got more income to dispose of. So that's why the inflation booms. Let's suppose inflation is getting close to 4%, 3% kind of. So it's the mandate of a central bank to keep it to 2% to keep the economy at the healthy grounds. So what the Federal Reserve is going to do is that it is going to make the same interest rate up. Let's suppose 3%. Now again, there's more risk involved in lending, so the bank will keep themselves away from lending unnecessarily. Okay, because of the emergency funds will now cost more, so bank will just limit themselves to the necessary financing. So this is how the economic activity will be contracted in that kind of economy again. And yeah, this happens when the economy is close to crisis and when there's too much inflation in the economy. There are a lot of other complexities involved in this system, but yeah, this is the simplest example I just gave you, and I think you got my point clear. So subscribe to my channel too so I can put up more stuff like this. Bye.